First EDS, then Hewlett-Packard, and now Blackstone. This 16-year-old homegrown IT company has seen its third change of guard. After 2 years of negotiation, Blackstone has agreed to acquire a controlling 75% stake from HP in India's 7th largest IT company for over $1 billion. Yes, the company that we're talking about is Mphasis. And as Mphasis embarks on this new chapter in its life, we're forced to ask two key questions. Will Blackstone's boldest bet pay off? And will the new promoter succeed in erasing a weak 5-year track record? A lot of it will depend on the CEO, Ganesh, Ayyar, whose immediate concern, though by no means his only concern, will be to ensure a smooth transition. To answer these questions, we're now joined by the man himself, Ganesh Ayyar, the CEO and Executive Director of Mphasis. Ganesh, before we get chatting about the company, let's quickly run our viewers through the deal contours. In 2009, Hewlett-Packard picked up a 60% stake in Mphasis and became a premier client for Mphasis. As of the Jan-March quarter, HP contributed to about a fourth of Mphasis' total revenues. But the problem was that when the stake was first picked up, HP accounted for nearly 70% of the company revenues. Apart from a tough global economic situation, one reason for the decline was that HP has been trying to sell the stake in Mphasis for a while now. Now HP has signed on the dotted line with private equity firm Blackstone. So Blackstone will pay HP 430 rupees per share for the 60% stake. In addition, Blackstone will make an open offer for an additional 26% stake at 457 per share for a total size of $1.1 billion. For Mphasis, the change in promoter comes with a sweetener in the form of a minimum revenue commitment of $990 million from HP over the next 5 years. Speaking on the future business, the arrival of Blackstone gives HP an opportunity to tap into Blackstone's portfolio of companies as a prospective client. And that's a gold mine as far as industry watchers are concerned. Hi Ganesh, this deal actually seems too good to be true. For 16 quarters, the revenues from Hewlett-Packard declined. When we last spoke to you, you had no visibility on when HP would bottom out, and suddenly come Blackstone and they've given you a $990 million revenue commitment over 5 years. What changed?
Actually, this is the breakthrough I've been looking forward to. Every quarter when I was asked this question, where is the bottom of HP revenue? When will the decline start? I was hoping we will get a breakthrough. Here is the breakthrough. $990 million of revenue committed over next 5 years is indeed one of the two highlights of this particular partnership with Blackstone. The second one being the portfolio companies having an addressable space of $1 billion. So as I said, I feel like a kid in a toy shop, excited, and I believe whatever you have heard and researched, it is true. I won't call it too good to be true. It is definitely a good breakthrough for Mphasis.
So HP revenues will bottom out in FY17. Give us a sense, because you've indicated that the revenues over 5 years will be on an escalating basis, accumulating to $990 million. So how much roughly in FY17, or would it be largely back-ended?
See, in Q3, our run rate was $220 million. Right. We have been experiencing 21% decline every year. If not for this breakthrough, and if we extrapolate that data, we would have arrived at roughly about $172 million. And if you average the next 5-year revenue, it gives you close to $200 million per annum. So even minimum revenue guarantee is actually a positive note for our revenue with HP. The second element is preferred partner. If we just deliver minimum revenue, I think we have failed. We need to go for more. So that is what is exciting for us, for employees, because they have dealt with this uncertainty. Now there is certainty.
These revenue commitment deals generally come at a cost. Can we say for certainty that the revenues from HP will not be margin dilutive?
Our model is not based on margin dilutive, and we are very, very clear that Mphasis has to tread a path of improving margins. So we will not enter into a transaction which fundamentally dilutes the existing margin profile of Mphasis. So you can be rest assured that this particular MSA is based on win-win between three parties, namely HP as the customer, we as the service provider, and Blackstone representing our future majority share owner, and other shareholders too.
How soon will you be able to mine the $1 billion of revenues which you can get from the 80 portfolio companies of Blackstone?
As we speak, Rima, we are doing analysis of their portfolio companies. We will attack those 80 companies or select companies from that portfolio with our horizontal offering. Once we have done the analysis, we will have the battle plan ready. I'm hoping that we will go with guns blazing. We are creating a separate team to go after this business because it is a huge business, huge positive for us. We won't do it by spreading ourselves too thin. A focused team with focused effort. After we have done the analysis, we will staff it with the right talent, and let's see. I mean, our aspiration is not to wait for 5 years.
Now, speaking about $1 billion, you hit $1 billion in terms of revenue way back in 2010, and you're still somewhere there. Even, I was looking at the quarterly revenue run rate. In October of 2010, your quarterly revenues were at $290 million, and in December 2015, it was at what, $230 million? I agree that it's an account of the decline in HP, but there hasn't been growth in Mphasis. For the next 5 years, with Blackstone as a promoter and the revenue commitment that you have from HP, what will growth look like? When will the consolidated revenues of Mphasis hit industry growth rates?
We want to be and we will be a growth-oriented company at an overall company level. If you look at last 5 years, HP revenue used to be 72% of our revenue. Now they are trading at about 24% of our revenue. So from $700 odd million, they have dropped to $220 million. So instead of thinking like a victim, we thought, how do we solve the problem? So we grew the direct revenue stream. So even though we are at total company level,
but we still have to look at the company on a consolidated basis, right? So would you hit industry growth rates in FY17? Would it be 18? Give us a rough timeline.
See, if I focus on my personal aspiration, I would like to hit above industry growth rate in FY18. 17 because by the time the transaction closes, our preparedness will take time. In FY18, we should be touching the industry growth rate or should be above that.
Okay, that's very good to hear. What about the cash in the books? More than 100 rupees per share, closer to 112 rupees per share. What are Blackstone's plans with it?
See, cash strategy for us has always been influenced by our board. And what we are going to do is we are going to make that decision in conjunction with Blackstone post the close. I'm sure Blackstone has plans, we will have plans, and they would listen to our strategy and we will chart the course ahead. As of now, I'm not clear what's going to happen, but just stay tuned. Transaction will close in 3 months and you will have it. And I'll make sure you get the call from me.
Speaking about uncertainty, I think your shareholders would also like to know that what changes Blackstone plans to effect now in Mphasis. They must have given you some time. I was reading somewhere that Blackstone has this 100-day strategy where they either restructure the board or they fix the processes, which will determine how the next 5 years will be. See, what is the communication to you?
What will happen is we will identify certain success themes which will take us towards breakthrough success. And around those success themes, we will double down collectively between Blackstone and us to see how do we ensure those themes succeed. So that gives us the breakthrough results. And I'm looking forward to having best of advisors helping us to navigate those success themes.
What about attrition then?
Attrition of employees?
Yeah, would they be looking at scaling down some sort of a cost cutting to improve the company margins?
I think this is going to be a growth-oriented partnership. So focus has got to be on how do we generate greater revenue and relevant revenue. Now, as far as margin improvement is concerned, we have always been on that ever-accelerating treadmill. We will continue to stay focused. If there are better methods to increase our productivity, we would be all ears. But the focus has got to be growth, relevant growth, specialized growth, because industry is facing uncertainty of digital revolution which is unfolding.
So apart from hitting industry growth rates or beating it in FY18, in terms of a financial improvement, what is it that Blackstone, what is the targets that Blackstone has set out for you all?
We want to be seen as a winning company.
Truly, what does that mean in terms of numbers?
I'll share that. We want to be in the top quadrant of generating shareholder value and growth. Okay. That is our aspiration. Now this platform of partnership with Blackstone gives us that opportunity.
On that optimistic note, it's time for a very short break, but we have a lot more questions for you in terms of the transition that you plan to effect at Blackstone, as well as the key changes Blackstone's might effect after we return from this very short break. Welcome back. Mphasis has gone through its troubled times in the last 5 years, but the Blackstone acquisition has fueled hopes of a turnaround. Take place. We've been in conversation with Ganesh Ayyar, the CEO of Mphasis. The company Ganesh has gone through challenging times, largely on account of the big revenue decline that we saw in HP. But through it all, what has stayed constant, through even perhaps the multiple changes in promoters, has been the fact that the company continues to make a lot of acquisitions. It's been 9-10 acquisitions since inception. Will that continue?
See, we are actually looking at acquisitions in the area of overlap between digital and governance, risk and compliance. That's an area of interest because we are doing well. We want to bring high science solution into those areas. We have already got a startup called Next Angles, which is working in that area. So we would continue to look for it. Once the cash strategy is defined, then we would be in a position to see what targets we want to go for. We prefer smaller acquisitions rather than a big one, and especially with somebody with IP rather than scale, because the future of this game is not scale alone, it is actually specialization. So that's what we are going to go for.
But speaking about specialization, ever since you've taken over as the CEO of the company, there has been a lot of focus on hyper-specialization. You decided to focus on banking, capital markets, insurance, and now it contributes more than 50% to your overall revenues. Will there be a change in that?
Our strategy is dictated around an inch wide and a mile deep, which means specialization. With automation coming, Reema, generalist will fall by the wayside. That is the core belief. And if you want to move up the value chain, you have to understand customers' business. As a small company, we could afford to do it in one big vertical called BFSI. And that has been our focus. Will we add vertical? We actually take an annual look. Should we add another vertical? But we won't do it at the dilution of our focus on BFSI. And there is significant headroom for us to be successful in BFSI.
So while focusing on BFSI, are you looking to add any verticals?
We evaluated a couple of industry verticals 2 years ago, last year.
And right now?
We will evaluate again.
But there's nothing on the horizon which looks...
Nothing immediate, nothing imminent. But we are open to adding one more vertical, not because we feel that BFSI is a problem statement, but because we think that we can spread our wings and be effective in another vertical. That should be the reason.
Fair enough, but speaking about BFSI, I was reading a recent report where they did an analysis of the expectations of the top Fortune 500 banking companies or finance companies in US and Europe for the Jan to March quarter, and they're expecting a 12% revenue decline year on year, a 30% decline in the Fortune 500 banking profits in this Q1 CY16 quarter, and they're saying that this perhaps could be the worst start to the year for the banking sector in US and Europe since 2008. You don't see too much specialization on banking. A little worrying at this current stage as things stand?
Not at all, because our job is to make our customers successful, whether they are in hyper growth mode or hyper cost optimization phase, or both. So in 2008-2009 we grew 45% when the entire world was going through global financial crisis. Whenever a customer looks at optimizing cost, we have to be in tune with it, and we do have the ability to optimize costs for our customers, only in select areas. I can't do it for all areas, so I'm not at all worried about the trend which we are seeing. And remember, what you are talking about does not capture their investment in digital, and it does not capture their investment in governance, risk and compliance. Governance, risk and compliance will continue to attract investment, and digital will have hyper focus in terms of investment. Traditional IT services will shrink, whereas digital will grow. Governance, risk and compliance will be very, very stable.
What percentage of your revenues currently comes from digital, and how will it change, say, in the next 12 months?
So if I turn this question slightly, new generation services, new wins. Last year, 65% of my new wins came from these areas. Until Q3, 52% of my new wins came from these areas. So we are clearly winning in areas where customers are investing. And what will happen is this will translate into revenue. So revenue is a lag indicator. You will start seeing this flowing into our revenue. Last year our revenue pattern was 34% was coming from new generation services. We expect it to grow much faster.
How much would it go up to?
I hope in next 3 years, significant portion of our revenue is from new generation services, which means majority of our revenue.
Okay, fair enough. But I'm assuming these new generation services come in at higher margins, right? Compared to legacy?
It's distinctly possible.
So your margins should improve in the next 3 years once new generation services contribute more than 50%
As I mentioned
of your
earlier, we are aspiring to improve our margin profile.
To what? Because industry is clearly at more than 20%, right?
No, so you know there are
Way
two
more.
camps. There are two camps, and you know this better than I do.
Yeah.
Tier 1 or based on size, which is 4 billion and above, operate in 22-25% range. Then you have sub billion or sub 2 billion. They operate in EBIT terms around 14 to 16%. We are still sub billion or sub 2 billion. So we hope to beat this profit pattern over a midterm period. And then will we reach 22%? I don't have a line of sight today.
But at least you should go up to 16%, which is in the
That is our aspiration over the next 3 years, and we have plans aligned to it.
Speaking about uncertainty, how are you planning to maintain the client connect and make sure that the transition becomes smooth, whether it's to do with your clients or even to do with your employees?
That goes back to our culture. We actually leverage the fact that we are a smaller company. Because when you're a smaller company, you maintain that intensity, that touch with the customer. Because customer is everything to you. I want to retain that culture. Even this particular transaction, we wrote to 593 different individuals in our customer base.
Okay.
I wrote to 15 customers and I got reply from 14 of those. And the sentence, their reply started, congratulations, do let us know how can we help you.
And out of those 593 clients that you reached out to as a company, positive response came in from?
Literally, majority of response was tremendously positive and some of the response was neutral. There was no negative response from our customer base.
We've spoken about a lot of opportunities that Blackstone as a promoter brings to your company. What about the risks? What perhaps will keep you awake at night?
So, nothing keeps me awake. I sleep all right. And
Except work. Except a lot of work, working 20
when you
hours a
start
day.
enjoying work, that itself becomes life. So to that extent, I just love what I'm doing, working with my team and my customers. So the risk is, will I be able to transform myself to the new environment? The risk is whether my leadership would be able to transform itself to the new environment. We are not taking it lightly. We are working on our own personal change management. Last but not least, our success should be reflected in for our customers, our top talent, my leadership team, and our shareholders. So it will require me to take the entire community along in this successful journey. And that's why I'm hitting the road for the next 4 weeks, because communication is key to taking the entire community along. And I appreciate CNBC and you, Rima, personally reaching out, having this conversation, because I always enjoyed such a conversation with you. You are well researched.
Thank you so much for that, and we appreciate you having us, talking to us. But just, one more question. Of late, we've seen a lot of deals in the IT space, whether it was Virtuoso acquiring Polaris or in HCL Tech acquiring Geometric, and now Blackstone acquiring your company. Is there any trend to it? Is there any particular reason that all the deals have just culminated now?
When the traditional markets start drying up, you tend to see a lot more consolidation.
So we'll see more of it?
I personally think you will see more of it. Not only that, over the next 5 years, some big trees may fall, because that's what happens when there is a major transformation in the market. So all of us have to be alert. I'm not wishing them that they should fall, but it is important for all of us, including me personally, not to take it for granted and be ready for the future. Don't live in the glory of the past. Embrace change.
So is Indian IT ready for the digital transformation, or not all companies?
No industry is ever completely ready. And we have seen many trees fall in different industries. We are not immune to it, and we just need to be alert and be prepared to transform right from the board, the CEO, down to the last person who is serving the client. We cannot take this lightly. There is no moment where we should become complacent.
Thank you, Ganesh, for taking the time out and speaking to CNBC TV 18. I'm sure Mphasis will ride through all this transformational phase in the Indian IT sector and come out right on tops, and perhaps one day will soon be in the top quadrant of the Indian IT industry, as you predicted and hope. Thanks once again for your time.
Thank you so much, Reema.